It begins with a contradiction so deep that it feels almost invisible. The United States celebrates free markets, competition, and decentralization, yet a narrow stretch of streets in Lower Manhattan holds disproportionate influence over the global economy. Wall Street claims to merely reflect market forces, but time and again, markets around the world seem to bend in its direction. The mystery is not that Wall Street is powerful, but how that power became so absolute. Most people believe Wall Street's dominance is the natural result of innovation, talent, and risk. That explanation is convenient, even comforting, but it ignores an unsettling reality. If markets are meant to reward efficiency and discipline failure, why did the same institutions survive every crisis stronger than before? And why do global shocks so often end by reinforcing American financial supremacy? To uncover the forces behind this dominance, we have to return to the origins of the U.S. financial system. In the early years of the Republic, America had no central bank, no unified financial authority, and no global ambitions. Banking was local, fragmented, and volatile, tied closely to land, trade routes, and political influence. Throughout the 19th century, the United States lurched from boom to bust. Financial panics in 1837, 1873 and 1893 devastated ordinary citizens, while well-connected financiers often emerged intact. These crises revealed an early pattern. During instability, capital flowed toward institutions closest to power, information, and political protection. The Panic of 1907 pushed this pattern into the open. As banks collapsed and markets froze, the federal government lacked the tools to respond. Instead, private financiers organized rescues behind closed doors, stabilizing the system through coordination rather than competition. This moment planted a lasting idea that financial stability depended on centralized authority aligned with elite interests. In 1913, the Federal Reserve was created to prevent future chaos. Officially, it was meant to stabilize markets and smooth economic cycles. Unofficially, it became the anchor of American finance, linking government power with Wall Street liquidity. This institutional marriage would quietly reshape global markets over the next century. In its early years, the Federal Reserve demonstrated how profoundly policy could influence outcomes. Loose credit fueled expansion and speculation, while tightening triggered contraction. Each cycle reinforced the Fed's authority and taught markets that survival increasingly depended on access to U.S. monetary power. The 1920s offered a dramatic demonstration. Easy money and optimism drove massive speculation in stocks and real estate. Wall Street thrived, inequality widened, and leverage soared. When policy tightened, the collapse was swift and brutal, concentrating financial power even as it destroyed public confidence. The crash of 1929 and the Great Depression shattered illusions about self-correcting markets. Millions lost jobs and savings, while the financial system nearly collapsed. The lesson absorbed by policymakers was not that concentration was dangerous, but that centralized intervention was essential. New Deal reforms reshaped finance through regulation, deposit insurance, and oversight. These measures reduced certain risks, but they also made large American banks safer than most of their global counterparts. Stability at home became a magnet for international capital seeking refuge. World War II accelerated this transformation. Government spending revived industry, and Wall Street became deeply entwined with state power. When the war ended, the United States stood economically unrivaled, and its financial institutions were positioned as global custodians of capital. The Bretton Woods system formalized Wall Street's global role. By tying international currencies to the U.S. dollar and the dollar to gold, the world anchored stability to American institutions. Trade, reserves, and savings flowed through U.S. financial channels, amplifying Wall Street's reach. Even under Bretton Woods, cracks formed. When uncertainty rose abroad, money flowed into dollars and American banks. Wall Street was no longer just a marketplace. It was a refuge. U.S. policy decisions increasingly shaped outcomes far beyond national borders. In 1971, the system reached a breaking point. The U.S. abandoned the gold standard, transforming the dollar into a fiat currency backed by credibility rather than metal. This single decision expanded Wall Street's influence by removing external constraints on U.S. monetary power. The 1970s tested this new flexibility. Inflation surged, eroding trust and wages. When interest rates were raised sharply, the dollar strengthened. Global capital rushed into U.S. markets, and debt crises erupted across the developing world. Wall Street absorbed the inflows. The 1980s marked another escalation. Deregulation loosened constraints on banks, financial innovation multiplied leverage, and globalization accelerated capital mobility. Wall Street institutions grew larger, faster, and more interconnected than ever before. As markets globalized, risk traveled outward, while safety concentrated inward. Crises in Latin America, Asia, and Eastern Europe sent waves of capital toward American assets. Each shock reinforced Wall Street's role as the system's ultimate backstop. The 1990s illustrated this dynamic vividly. The Asian financial crisis saw currencies collapse and economies shrink, while U.S. markets surged. Capital flight abroad translated into strength at home, embedding Wall Street deeper into the global financial core. The dot-com boom followed familiar lines. Cheap capital fueled speculation. Valuations exploded, and confidence peaked. When the bubble burst, losses were widespread, but recovery centered on monetary easing that once again favored large financial institutions. The early 2000s repeated the cycle on a larger scale. Low interest rates inflated a housing bubble, and Wall Street engineered complex products that spread risk worldwide. When the system collapsed in 2008, it exposed fragility at the heart of global finance. The response to the crisis revealed Wall Street's true position. Trillions were deployed to stabilize financial institutions, while households absorbed lasting damage. Markets learned a critical lesson. Wall Street was too central to fail. In the years that followed, inequality surged. Asset prices recovered rapidly, while wages lagged. By the late 2010s, the top 1% controlled more wealth than the bottom 90% combined, and financial markets revolved around central bank signals. The pandemic of 2020 intensified this dependency. Massive interventions stabilized markets overnight, even as economies shut down. Wall Street rebounded faster than ever, confirming that policy protection was now built into the system. Globally, the consequences were stark. U.S. rate changes reshaped capital flows, destabilized currencies, and strained governments worldwide. Decisions made in Washington and New York reverberated across continents within minutes. Repeated attempts at reform failed to alter the structure. Regulations softened, banks consolidated, and political incentives favored short-term stability over systemic change. Wall Street's dominance proved resilient because it was institutionalized. Today, a handful of financial firms manage assets worth multiples of global GDP. 3 index fund giants hold decisive stakes in much of corporate America. Wall Street no longer just intermediates markets. It defines them. The first takeaway is that Wall Street's dominance is not accidental, but engineered through policy, crisis response, and institutional design. The second is that every disruption strengthens centralized financial power. The third is that global markets are increasingly shaped by American priorities. The unresolved question is whether this system can endure indefinitely. As debt mounts, trust thins, and alternatives emerge, the forces sustaining Wall Street may face challenges they cannot absorb forever. Understanding these hidden forces is the first step towards seeing global markets clearly. If this investigation reshaped how you view financial power, stay curious, stay informed, and keep questioning who truly benefits when the world's money moves.